Hello and welcome to Bloomberg Quint. Joining me today is Mr. Gopal Agrawal, the CIO of Mirae Asset Global Investments India. Thank you, sir, for joining us.
Thank you.
Let me start off by asking you, in this low interest rate environment globally and the impending US rate hike, what does it mean for the fund flows for emerging markets like India?
Okay. So what I would say that we are definitely in a low interest rate environment for a long cycle actually. So but any rate hike in US will have a short term volatility into the emerging market space, because we are seeing like today 14 trillion worth of bonds are in a negative interest rate environment. If there is a rate hike in US, which will have a negative impact actually, so you will see some volatility because of rate hike. But what I would say, the structurally the ultimate US rate will remain quite low for a long period of time. So you will see there will be continuous hunt for yields actually. In this space, the emerging market like India really fits very well. Only thing is that we have to continue to maintain control on our inflation, and we have to maintain a good current account deficit, which is the condition today. So you will see some short term volatility if there is a rate hike, but we are very constructive on the medium and longer term flows into the Indian market.
All right, so what is your expectation from the capital expenditure and the investments from corporate? Like, are you seeing any traction given the current market scenario, macroeconomic scenario?
So still corporate investment cycle is not picking up that well. Barring some of the efficiency improvement or debottlenecking which is happening into the corporate sector, we are not seeing any major capex has been announced by the corporate sector, except we are seeing good investment into energy sector, because the energy companies are in a pink of health, and because of their focus to reduce the pollution and go for BS6 norm, we will see some investment into the energy sector. Barring energy sector, right now we are seeing very less investment.
But then how important is the corporate earning revival in this quarter in order to support the Nifty valuations?
See, the market is really slave of earning, and the earning revival is very important for the medium to long term performance of the market. And what has happened in the last 3-4 years, the businesses which have given the double digit earning growth are trading at a significant higher valuation, and the vice versa. So now what we will see certain revival into the earning, because our WPI has turned positive after a gap of roughly 12 months. So you will see earning revival will happen, and that will be much more broad based rally into the market.
So what is your stance on the stocks from the IT sector? Because especially after the Infosys and TCS earnings, the margin fears still remain for most of the companies. So what is your reading on that?
See, this margin pressure is really structural, okay, because what has happened, the businesses are shifting from legacy to digital, okay. So any transformation is a painful, so we have to live with it, okay. So my sense is that the margin decline is a structural, but I am still constructive on the volume growth of the businesses actually. This now because of continuous decline into the margin, actually now the stock sectors are trading at a commodity valuation, okay. So which my sense is that may not fall much from where we have reached actually, but they lack a good trigger for a very big positive rally into the sector.
I believe you also manage the Global Commodity Stocks Fund, and in the recent run-up, we have seen a strong run-up in the downstream oil companies. So what is your sense about the oil prices? Where are they heading?
Okay, so the first of all, the oil downstream companies have done well, because we are seeing two things. Because of the certain collapse into the oil prices, the worldwide demand for energy has sharply increased actually. So we had seen 1.7 million barrel increase in oil demand in 2015 calendar year, and because of this the refining margins have just shot up. And second, at the lower energy prices and the reform taken by the government, the subsidy burden has come down materially. Okay, so because of these two things, we have seen the reduction in interest rate because working capital requirement has come down and the refining margin was good. So the downstream has done well. So my sense is that going forward, the oil will behave in a band. The Saudis' action will try to defend 40s, and Shell's lowering cost of production may not allow it to cross 65. So in this band the oil is likely to behave, which is very good for a country like India.
But we don't see a lot of NBFCs in your portfolio. So is the expensive valuations worrying you?
See, actually we were one of the few who has participated in NBFC rally, and the so we really made good money out of it, but at a valuation we really trimmed our position. But still I would say we are constructive on NBFC space because India is still underbanked country, and we are continue to see very good retail lending growth in the times to come. So the NBFC will benefit both from falling interest rate scenario and the good credit offtake. So we are constructive on this space. So at at a price, we are watching them very carefully, and we will have some more exposure in the time to come.
So which according to you could be the next NBFCs for the next 2 to 3 years?
No, still I would say, like let's say the housing finance company are still very good. Then what has happened, housing finance is today 60% of the total retail lending. So you will see other retail lending opportunity exist in many other spaces. So this will thrive, right? And with government curtailing the black money instances, focusing more on the banking and the digital transaction which is increasing, so which will lead to more credit penetration will happen. So this space really augurs very good in the medium to longer run.
So which sectors could be leading in the next bull run?
So my sense is that in the next 2-3 years, you will see more normalization of earning, and you will see more broad basing of the market rather than the narrowing market. So I won't say like the one particular sector will lead the market. So my sense is that in next 2-3 years the rally will be more broad based.
All right, and finally the US presidential elections are coming up, and also the December FOMC meet. So which themes according to you could be playing out?
See, currently all these things will have a very short term impact on the market because the ultimately what drives a market is earnings and liquidity. Okay, so FOMC rate hike will have some volatility into the market for sure, and but what I would like to share with certainty that in US the data point is not in a one way up. They are quite volatile, right? And so you will see that the FOMC it will be very reluctant and will go slow into the further rate hike, so which will have a positive impact in the medium to longer in the market. So in the short run, what I would say, it may cause some volatility. So better to stick to the businesses which are quality and which are more domestic centric businesses, which will do well in this scenario.